So for my retailers, a lot of them forget about their commissions and fees. Example, Amazon. Let's go there, or Etsy. Um, you guys get your 1099K for all the sales you did,
Right.
and you think, oh, that's my gross income. But if you go through your account, you will get a list of all the fees they were charging you per sale.
Oh, we also get this in Uber, right? Uber drivers,
Yeah.
they don't write off
Commission
the
sales,
commission of sales.
the Uber service fee,
Right.
the some of the instant pay fee because
Right.
you want to get paid quicker. All those commissions, like Etsy, they remit your sales tax, so you don't have to worry about that.
Make sure that if you are writing a profit and loss expense sheet for your tax guy, and your tax guy is not looking for extra expenses that you forgot, you have a good tax guy when he's looking for expenses that you don't have written down. If he's looking for extra expenses, then that means you have a good tax person. If he just writes off whatever you gave him, he's very mid, he's very average, right? Welcome to our tax podcast. I got with me my regular guest, that is Victor. Victor, he's a level 4 enrolled agent, and he represents people in court. He knows a lot about everything. He is the guru in taxes. Let's start off our podcast with you telling us a story, a crazy story about a client, something entertaining, something that will be like shocking to the public.
Misuse of 1099s.
Okay, I want to hear this. Let's see.
Specifically a 1099K. Okay. 1099K is usually when you use a third-party network, something like Square, Ubers, get 1099K, Lyft, of that nature. And pretty much if you're getting paid with a credit card or credit card machine, you're going to get a 1099K. For my business owners, your merchant accounts,
right?
That's your 1099K. Have a client, he's a manager for some stores he helps to set up.
Yeah.
Hasn't done taxes in multiple years, so we do what's called the compliance check. That means we get the transcripts, we see what years he hasn't filed, if he owes anything from the past.
This is one of the things that you do almost automatically. All the clients
new client, like, let's see,
new clients come in, let's just look at everything that's happened in the past.
Tax memory, people don't have tax memory.
No.
They have no idea when I last filed. Maybe I owe money, I don't know. For whatever reason, they don't know when they owe.
I'm always surprised how tax people don't do compliance checks when the clients walk in. They expect them to have all their documents. And then have perfect organization, which never
most
happens.
people don't know how to do compliance checks.
All right, continue with the story.
Client has moved 3 times prior to filing since 2020. So no letters from state, no letters from IRS, hasn't been up to date. When we pull the transcripts, yes, he has to file the most recent years, but the last year he filed, he was what's called an underreporting audit, a CP 2000.
Oh, so he got an audit that he never knew it happened.
The balance on that year was over $630,000.
So he owed $630,000 for 2021.
2020.
Oh, so he had a 600. Okay.
The big money.
Crazy.
He is like, I had a refund that year. How do I owe this? He's about to have a heart attack on me. So I pulled the wage and income. I tried to get that CP 2000. Turns out there was a 1099K with about 5 months of transactions adding up to $1.1 million.
Whoa, 1.1 million, huh?
So now the questions start. What do you do? Tells me I'm a manager. I get hired by different companies to set up stores, stuff like that. I'm like, okay, did you set up a Square account before they got their merchant account? And he's like, yeah, but I do that all the time. But, they reported it's not my income. Well, the 1099K was still under his social.
So he set up the credit card machines under his name accidentally instead of putting the business owner's name.
Correct.
So how many 1099Ks did he have?
We went through his history. This was the only one.
So there's one store that he just accidentally put his name on there.
That's it. Luckily, he was still in good terms with that ex-boss. I told him, give me their name, give me their EIN, give me everything you can from them. We wrote a letter. Now we open what's called an audit reconsideration, which is reopening the case.
We reopened the case.
So someone could take a look at the instructions. An agent confirmed that that's enough as long as we know what company actually reported that income. They will remove it from his transcripts, therefore it's not his income, and they'll reverse the entire balance.
Man, how often do we see clients filling out the W-9s, the W-4s incorrectly or whatever, right? Whatever information they have.
Correct.
Today, we're going to talk about small business tax strategies and also high income earner tax strategies. These are things you can implement to save tons of money, right? So these are things that is commonly used. I mean, there's 100, 200 tax strategies that can be implemented. Everyone's kind of a unique situation. But what are the most common ones that you see that you use in order to save people tens of thousands of dollars?
So let's start with our sole proprietors, right? Or a small business,
Small business.
self-employed people, contractors, maybe some 1099 people. When one thing people always forget to claim is their cell phone use. Don't know.
Yeah, why do people forget their cell phones?
Like everyone uses their cell phone for business.
Yeah.
Don't know why they forget that one. Which leads up to also the business use of home or the home office.
Home office. Always a lot of people will forget the home office. You know, a lot of people go to their tax guy and they're like, "Oh, I'm sorry, you cannot write that off for some reason." You know, all these people would need would be just say the office exclusive use for business and work. That little area, you write off the square footage. I mean, what's the likelihood of the IRS asking, like, the IRS actually showing up to your house and saying exactly the square footage that needs to be? I mean, the likelihood is
Low.
like astronomically low.
Not
Right?
to mention right now, because of the new agents, most audits are what's called corresponding audit, meaning they send you a letter, send information back. They're not really doing as many field audits as they used to.
And you just send them a drawing of the house, and you just draw in,
Picture.
take a picture, draw it in, say this is my home office, this is the square footage, and that usually goes through.
Have documentation.
Yeah, you just document it. Very simple, very easy, always goes through.
Recently, I've been seeing a lot of confusion with vehicle use. You know, you can do standard business mileage or actual expense. But because everyone getting confused about this bonus depreciation, everyone thinks they need to claim the actual expenses when probably the standard mileage is much easier and you get one hell of a deduction. It's 67 cents per mile.
People, if you're a sole proprietor, small business, and you drive more than 10,000
miles,
15,000 miles a
record
year,
'em.
it's better to do mileage than the actual expense of the car.
Yeah, because not to mention, let's say you have an electric vehicle or a Prius. Well, you're already saving a lot on gas or electricity.
That's such a hack, right? It's like you're not even spending money on gas,
but
and
yeah,
you still
you'll
get the mileage. Yeah.
Especially that's really for my Uber and my Lyft drivers. Like you could try to do what you can.
If you get a Tesla and you drive 20,000 miles, you wasted no gas, and then you just write off all the mileage. Dude, that is, how much is that? It's
7 cents,
$13,000, $14,000 deduction.
$14,000 deduction.
Yeah, I mean, you get a Type 3 Tesla. I mean, that's a half of what the car is worth.
And if you think, oh, well, I bought the $50,000 Tesla and I'm gonna write off $50,000, doesn't work that way because of depreciation.
Right.
There's rules to assets that live longer than a year, and you can't write it all off in 1 year.
So let's just clarify that. You can write off actual expenses, which is depreciation, insurance, payments,
car washes, gas,
or
repairs, based on the business percentage of the vehicle, which people forget that.
Yeah. So how often you use it for work, or
the miles that you use for business,
miles.
record them 67 cents.
Usually, driver with electric vehicles, mileage is king. Use it, abuse it. Don't use actual expenses. You can write all that off, get a humongous expense. Usually, if you sit down with your tax guy, he'll figure it out for you.
Not to mention, if you're an independent contractor and you have your home office, you started work at home. So now you're not commuting. Now you're going to different business locations, is all business miles.
If your tax guy is not telling you that you can write off the miles because it's commuting, you had the wrong tax guy. Talk to a CPA, tax attorney, tax person that is working for you, not against you. If your tax guy is telling you no, change your tax guy. What other things can we write off?
So for my retailers, a lot of them forget about their commissions and fees. Example, Amazon. Let's go there, or Etsy. You guys get your 1099K for all the sales you did,
right? And
you think, oh, that's my gross income. But if you go through your account, you will get a list of all the fees they were charging you per sale.
Oh, we also get this in Uber, right? Uber drivers,
yeah,
they don't write off the commission and sales,
the Uber service fee,
right?
The some instant pay fee because you want to get paid quicker. All those commissions, like Etsy, they remit your sales tax, so you don't have to worry about that.
Make sure that if you are writing a profit and loss expense sheet for your tax guy, and your tax guy is not looking for extra expenses that you forgot, you have a good tax guy when he's looking for expenses that you don't have written down. If he's looking for extra expenses, then that means you have a good tax person. If he just writes out whatever you gave him, he's very mid, he's very average, right?
It's the business interview, the interview of your business. Because like we said, it's never usually a no. Usually it depends.
So I have a question. What percentage of people forget one or more expenses on their profit and loss statement, or on their expenses?
100%.
So you're saying there's 100%
There's always something someone
there's always something someone forgot.
always.
People most of the time miss something that they did not write off, right? Okay, and what other expenses could a small business? By the way, there's hundreds of these. By the way, we're just going over the main ones, right? What about like health insurance? So how about retirement? What about all that stuff? What can any small business take advantage of this?
Small businesses or individuals can take advantage of it, but it becomes more itemized at that point. It goes towards your federal income tax instead of your entire profit. When you're a sole proprietor, once you change business structures, which goes into a different strategy,
Right.
then you get into finding ways of doing those write-offs towards the actual business income. For an example, if you're a small business and your profits already, our rule of thumb is $50,000 in profit. Now we want to change that structure to an S corporation.
Right.
Now you start going against self-employment tax.
That's a great tax strategy, guys. If you're making more than a certain amount, you got to switch that sole proprietorship, the single member LLC, switch it to an S corp, because then you don't, you can minimize the self-employment tax, which is a big tax deduction. It could be $20,000-$30,000 deduction depending on the situation, right? And then, as you go up in income, there's even more strategy that can be implemented. Give us a little more of once the sole proprietorship moves into that next tier.
Sure. Simple numbers. If you have a $50,000 profit, you're a single individual with no dependents, your self-employment tax alone could be up to $7,500. It's about 15.3%. Then you have federal income tax plus state income tax, depending on what state you're in. If you're in an S corp, yes, part of it has to be reasonable compensation. Some payroll, some W-2.
Rate yourself a nice low reasonable compensation.
Let's say on that 50,000, you do half. 25,000 is payroll, just for the example. Well, on the other 25,000 that you'll still take as a owner's distribution, you save that 15.3% on that money. So now you're saving close to minimum $4,000, if not more.
By the way, guys, if you guys need help with calculating reasonable compensation and doing the math that benefits you and not the government, give us a call. Well, we're there to help you. Usually a good tax person will have reasonable compensation calculators. You guys can do the math. You can plug things in, move things around just to make sure that fits according. And as long as you have a reasonable compensation calculator and you present that in an audit, it goes through 100% of the time. So reasonable compensation, minimize that to save self-employment tax, switch to an S corp. These are, by the way, for those smaller businesses. Writing off health insurance.
Yes, because now you're an employee of your business. So now your business can give you employer-covered insurance.
That's right.
So the business is now writing that coverage off. It's providing it to you as an employee. So it's coming off directly for your business income. Then there's accountable plans.
Oh, accountable plans. These are yummy.
AKA, to make it simple, reimbursements. To make it very simple.
Yeah, once you're an S corp, those accountable plans are awesome.
Yeah.
Tell us what an accountable plan is.
An accountable plan is, let me think of a simpler way to explain it, because I was about to go.
I like to call it as reimbursements for expenses that you incur. I'll do my definition.
Okay.
Reimbursements you have, like you pay yourself back for things that you spent money on that is business related. Home office, car, cell phone, supplies, office, transportation, lodging, travel. All these things could be deductible and reimbursed to yourself if you incurred it yourself.
AKA, if you use your personal card or you're using your personal home or anything like that, you get reimbursed by doing a reimbursement policy based on the accountable plan of your business. And you get reimbursed monthly for that use of vehicle, for that home office and whatnot. And reimbursements are not taxable, so you're taking money out of your business tax-free while the business is writing it off.
Another advanced tax strategy is also bonus depreciation. This happens a lot during the end of the year. People are trying to write things off. You can buy a house, fix your home office in certain situations, buy a vehicle, buy equipment. These are all expenses that can be bonus depreciated. Can you please tell us a little bit about that?
So depreciation in general happens when you're buying equipment, furniture, a vehicle, and it's something that lasts longer than a year. Bonus depreciation lets you claim a bigger percentage of it the first year you acquired it, and doesn't have to be brand new. It can be used, whatnot. For 2024, you can go up to 60% on bonus depreciation as of now.
And it looks like it might carry 40% over next year. It looks like that.
We don't know, but as of now, you can claim anything that qualifies for bonus depreciation, 60% of that as an expense the first year you acquired it.
Let me give you guys an example. You buy a Tesla X, you depreciate 60% of it, and which means that even though the Tesla, as I say, it's $100,000, you get that $60,000 deduction now, not later. But the thing is, you only put a down payment of 10%, right? If you put $10,000, so you spend $10,000 to get a $60,000 deduction. Is that how it works?
Yes, but you still have the car loan.
Yeah,
Don't forget.
you still have to pay the house. But let's say you bought the Tesla in December. December, you pay $10,000, you get a $60,000 deduction.
Correct.
On the car.
As long as it's over 6,000 pounds.
Right. The Tesla, that's why I use the example of Tesla X.
It's the X Plaid.
Okay, so the X Plaid is of 6,000 pounds. Use $60,000, only spending $10,000. So you get an additional $50,000 deduction now, and you can write that off on your taxes.
Correct. And then for equipment, furniture, things that are not vehicle related and are under 20 years of depreciation, with Section 179, you can write a
year life or less.
You can use Section 179 and write 100% off of that equipment.
By the way, one of the things we're going to touch on another podcast will be real estate. Real estate is one of those advanced tax strategies that everyone can implement, everyone can use, and they could be really, really, really helpful. We'll touch on that on another episode, but we'll talk more about that in the future. But for now, these were the most common tax strategies for small businesses. And thank you for coming. And I'll see you at the next podcast, right?
Sounds good.
All right, have a good one, guys.